Hi guys, this is Ruby with MRB Financial. Thank you so much for joining us on this weird floody Monday. For our topic of the week, as always, please don't forget to like, share, and subscribe to our social medias, as we are always looking to educate more people. Even if you share our messages privately with your friends and your loved ones, we never know who we could help out. So with that, I'm going to go ahead and start with our topic of the week. For today's topic of the week, it is on the importance on having good credit when going into business. And we are going to go ahead and cover some basic foundations that I think it's going to bring a lot of light to people. This is a huge topic. We actually did a survey, and we asked, our listeners, we asked different people on what do you want to hear. We moved from the tax season into, the rest of the financial house. So going forward for the end of the year, we will still cover some tax topics. As you know, we all know that the tax deadline has been extended to July 15th. So, as it evolves, we will go ahead and touch on those topics, but we're going to go ahead and move away from that, at least to the end of the year. We're going to go ahead and talk about other financial topics that, affect your home. So the topics that we are actually talking about today is a combination of three different people. It just kind of meshed well together. So we thought, why not just take three topics, I guess. So thank you so much for sending that. Thank you so much for cooperating with us. We greatly appreciate it. And let's get on with it. I hope you see a lot of value in this. The thing about going into business, money. Everybody wonders how much, what do I need for me to go into business, right? So that is one of the things that we're going to talk about. When you go into businesses, you're going to need capital, you're going to need resources. Basically, just money is going to be needed. And then what type of company should you set up? What's the appropriate type of company for yourself? There's, you could stay as a 1099, which is a contractor role. You could be a sole proprietor, you could be an LLC, you could be a partnership, you could be an S Corp, you could be a C Corp. There's a lot of options, right? So we're just going to cover the very basics on how to, the importance of having good credit and how you would go about, or depending on where you are, who could help you with, your resources. And of course, tax planning and budgeting is huge for business owners, for anybody really, anybody looking to, get into the sector. They're gonna need their financials in order. Well, budgeting is very basic. Everybody budgets in this world. So we're gonna go ahead and touch, like I said, everything's gonna be very basic, but enough to keep you chewing and enough to get you going on, thinking what it is that's right for you. The thing about business owners is that we're all just focused on, making money, serving people. At the end of the day, that's all we want to do. We want to put our service in front of somebody and say, this is how I can help you. A lot of people are not very well versed into the bookkeeping, into the accounting, into the financials, into the, marketing. Like, there's just so many things to a business that business owners, a lot of the times, get swamped and they go on overload mode when they see all these things that they gotta see. So, the bottom line is we all just want to serve. And at the end of the day, everybody's looking to add value to somebody else, right? So if you're not a financial person, you're probably not really, concerned about your books, your accounting, your bookkeeping, your tax representation. So those are the necessities that a business needs just to stay alive. And those are the requirements that you need to have in your business to stay compliant, to continue to thrive, and to keep swimming with the rest of, the business world. So let's talk about choosing your business formation. How would that look? 1099. We've covered this in our previous videos. If you go back to like January, we have a very, I want to say December, we have a very basic 1099. And then if you go to our Spotify channel, we also have Business 101. We also talk about that. So I believe that one was also in January. So if you want to get more into that detail, those will be the 2 time frames that I would ask you to go back. So a contractor, you're technically not a company. You're just running solo, and you're just saying, hey, I have these services and I want to offer them to you. And you exchange service for money, but there's no business set up. Everything's under your name. It's just you as a person doing business. There's no business separation between you and your taxes and your clients. Everybody knows you as your name. There's no business name for yourself. Under this, you pay your own taxes on your own. You pay into your own Social Security. Fast forward to when you pay your taxes, unless you are already doing the tax planning piece, which is you're appropriating each quarter whatever tax you got to pay. Generally speaking, it's a 30% that we ask everyone to, tax plan appropriately. This is before any earnings, and this is before any other payouts that you have to make, because that's what you're going to end up paying taxes with. If you know what credits and deductions you earned for that year that you could put up against that 30%, by all means use that tax bracket to get you as close as possible to whatever your tax liability would be. So that's generally speaking for most businesses. So that's what a contractor is. A LLC is a limited liability company. What that is a new business that was set up not long ago by the tax entities and just different government agencies that noticed that there was a lot of misuse in the S corps and the C corps due to lack of education, due to lack of whatever it was. People were just not using them properly. So they said, hey, you know what? Let me give you a new alternative. Let me make this company for you. You can morph this company according to however you want to. So an LLC is a business structure in the U.S. where owners are not personally liable for the company's debts and liabilities. They are a hybrid entity like I just described, and you could combine all the different characteristics from the S corp or a C corp. And it behaves a lot like a 1099 too, when you look at, the holistic side of it. The only difference is that from going from a 1099 into an LLC, you're basically saying, hey, I'm a business owner now. This is my company name. This is my articles of incorporation. This is my EIN. This is whatever documents you did to separate you as a person from the company itself. The LLCs may elect not to pay federal taxes as well. Instead, the profits and the losses go into the personal filer's income tax. Or the LLC may choose also a different classification, like we said before. It could say, I want you to tax me like an S corp because I want to behave like an S corp, and I'm going to follow these rules to comply with my selection of taxes. That's one thing. If fraud is detected, or if the company hasn't met the legal filing and reporting requirements, creditors may go after the members. So let's say that you are not if you're telling a different story from what is actually going on in your book of business, that limited liability of that's supposed to serve the company, that gets thrown out the window basically, because you did not follow the rules, you did not treat it like it was supposed to be treated. One way to eliminate the risk of, being limited, having some type of liability, what a lot of people do is they just buy a chunk of insurance. They'll go ahead and get a good insurance policy for the type of risk that they think that they're going to be. It's a risk. Every business has a risk. So everybody needs to learn how to identify the risk and how to mitigate the risk, right? So that will be part of your insurance process of saying, hey, this is what potentially could happen, and then get insured for that. Who would do this? Also, an LLC is good for like people that want to separate their businesses. There's people that don't have just one business. There's people that have multiple businesses, but they don't want to deal with the messing of an S Corp. An S Corp is the next level, which we're going to get into that now. An S Corp, so the LLC, you could choose to just have a bunch of little LLCs. Let's say this is very good for real estate investors. This is really good for business owners that perform different types of businesses or services, I should say. Let's say that you provide a service during the day, you're 9 to 5, you're an insurance agent, but your part-time job is you like to buy real estate or you like to buy stocks. Well, you're going to have a company for your services, and you're going to have a company for your real estate or your stocks. So let's say you do the 3 of them, you would have an entity for each one of them. You don't want to mix them up, because if you were to get sued, the insurance policy that we just talked about is only going to cover the specifications that you purchased. It's not going to cover anything other, because you didn't say anything else. You didn't say, oh, you know what, I need this or this and that. Different conversation, but just to give you an idea. Those are the folks that would go and, go about that. An S Corp is known as a subchapter, which refers to a type of corporation that pays the tax on a specific built-in gains and passive income at the corporate level. Setting up your corporation as an S Corp gives you a lot of credibility. Remember, we were talking about credit, right? So I know I'm talking about a lot of different things, but just follow me. I promise it'll make sense. So an S Corp is that company that just makes you very legit. And it just, when you go to a creditor and you're like, hey, I have this company and I want to buy inventory, or I want to get a line of credit because I like, I need it for this, my payroll, or whatever it is that you need it for. The lenders are going to look at you more. They're going to be like, oh, okay, let's talk. Because that means that you're you understand financials better and you have a better grasp of the business world. That's what people assume right away. So it will be very important that you do understand all the different things that you do have to do with an S Corp company, because an S Corp company does have the thing about complex accounting that it comes with it. That is a downfall about an S corporation, that it's just like a C Corp in a sense of you have to do and file your documentation a certain way, and if it's not done a certain way, the tax, the IRS, the tax authorities could come after you for not doing it right, and they could shut down your business. I'm sure everyone has heard about a lot of, companies that have gone under because they did not do their book of business properly, due to, they didn't know, or due to fraud. So according to the IRS, these are the companies that they look at a lot. I'm not saying that they don't look at the LLCs, but there's more room for error in the S corps than there is in the LLC. Remember how a little while ago I talked about how they created the LLC because, and one of, or the good things about an S corp is that the S corp does not pay taxes at the federal level. It does pay taxes at the state level, but not the federal. So this saves money on a corporate taxes, especially when, when a business is newly established. This is a huge plus or a huge benefit for the company. But like we said, the state taxes are still due. Other advantages include the transfer of interest, meaning that an S corp and a C corp can go on and on. You could sell it, you could, do whatever. The company would continue on until it dissolves, versus an LLC. An LLC is only active until the owners decide that it's active. Let's say that the owner passes away. Well, there's no, if it was a sole proprietor, there's no more benefit to that. Let's say that it was an LLP, which is a limited liability partnership. Well, then the next the partners with it, make sure that they have the right documentation in place to say, what would happen to the company, in the death or, the loss of one of the business owners. So yeah, so that's about the S corps. Now into the C corps. The C corps is just like an S corp, but it's one of the top ones that most giants use, that they know they're gonna go ahead and become this big entity. This is where you see your Johnson & Johnson. This is where you see your Ford. This is where you see your American Airlines. Think of all those huge companies, which, it has owners, it has shareholders. They are actually taxed separately from the entity, creating a double taxation on it, meaning that the C corporation is going to get taxed at their C corp level, according to their taxation. So let's say that, let's say 30% is the average that, everybody says put on the side. If you, like we said, once we know what deductions, what credits we earned up against our business, well, that's after the fact, but we still have to account for what taxes I would have paid, because I can't always rely that I'm going to get those credits. So look at it that way. Like those credits, like they might change year to year. So you can't always forecast that you're going to get these credits or these deductions. So that creates that double taxation of the company is going to pay the C corp level taxes, and then the owners, the shareholders, when they receive their income, they're going to get paid. They're going to get taxed at the regular level. So think of, you're the owner, but you happen to be active in your company as well, and you get a paycheck. You're going to go ahead and pay taxes at ordinary level like everybody else. That's the way that your paycheck would be considered. If you go the dividend way, well, then you would follow the rules for paying taxes, on dividends. C corps compared to an S corp, and even the LLCs, everything goes to the C corp. The C corp is a totally different entity, and the C corp is the owner of whatever assets are in it. So if you bought a car and you said, I'm going to put in this car as part of my piece of the pie, that car is no longer yours. If you decide to leave, you decided to give it away. When you leave the company, you know, they're going to look at the financials and they're going to say, okay, well, based on today's earnings, based on what's going on today, this is your piece of the pie. It's not like you could go back and say, well, give me my car, give me this. It doesn't work that way. You're going to have to take some piece, and you're going to have to make sure that if you do decide to go into a C Corp, you know, one of the things about a C Corp is that you need to make sure that you have a meeting at minimum once a year. They do require that C Corps have a 1 year meeting at the very minimum. And there has to be a board of directors that are voted on by the shareholders. So it's not like you could just put whatever board of director you want on there. The shareholders have to vote this person in and say, yep, I believe that person is going to have my best interest in place. At the end of the day, being a part of a board, it means that you have the best interest of the shareholders, the owners, meaning that they are hiring you to serve their needs, and you know that's all within the contract. So very important that you understand that if you are going that route, all of the different pieces, all of the puzzles that you know have to be put together. You have to keep voting records of the company's directors and a list of all the owners' names and the ownership percentages. This is something that's also done on S Corp as far as the percentages and the names of, you know, when you have it, you got to make sure that you are allocating the appropriate ownership percentage for each one of the owners. So as far as the C Corp, I think that is pretty much it. It is required to register with the Securities and Exchange Commission, so that's a big thing. Upon reaching, you know, specific thresholds, the ability to offer shares of stocks is what allows a C Corp to obtain a large amount of capital to grow. Remember how we said about S Corp that when you go to a lender, you're like, hey, I have an S Corp, you know, I need to borrow some capital because I have, here's my business proposal. Be sure to always start with your business proposal, because that's going to help you. That's going to be your lay of the land. That's going to help you drive through, you know, whatever you got to go through. The C Corp is even looked at more highly because there's more people involved as well. And S Corp, you don't necessarily need to have a you know, board, but with a C Corp you do. So they look at it like, okay, there's people managing this company. They're serious. There's salaries being paid here. There's money at stake. People already put a lot of money into this company. So yeah, they're gonna look at you more, but you know, they're gonna make sure that when you register with the SEC, it's not just a matter of saying, hey, I'm a new company and I want to sell some stock. No, the SEC's gonna look at the board members. They're gonna say, okay, that's fine. Give me your application. You submit your application. You're like, hey, I want to be, you know, this is my board. This is what I want to do. And then the SEC is like, okay, everything looks legit. Everyone looks great on paper. Everybody's got good credit. Everybody doesn't, you know, you guys don't have any tainted stuff on your, you know, your background, nothing like that. There's no red flags for us. So go ahead, we'll approve you. But if that's not the case, if you look questionable, if your board members look questionable, you're going to be questionable, right? So be sure to take all these things into consideration when you do decide to go a C Corp route, because you're only going to be as big as the investment that you put in. You're only going to be as good as the investment and the effort and the resources that you put in. So you want to put all kind of good, you know, goodies in your business, right? So yeah, so that brings us on to the how do I get capital, which brings us to the topic of credit, which kind of just went really nicely with this. As you could see, credit is just looked at. It's your report card. It's really what it is. You know, do you have a D? Do you have a C? Do you have an A? Do you have an A plus? You know, because everybody loves the A plus, you know. So it's very important for you to really understand your credit, because it's something that's basic. It's not anything that people can't understand. It's just a lot of the legalities to it. All you gotta know is you get a bill, you pay it. You pay that time because you're good at, that's your report card of how you pay you manage your money. As a business owner, you're always gonna be needing cash. If you're gonna be on a growth mindset all the time, you're gonna need to figure out creative and fancy ways for you to grow your business, because it's just the way it works. In order to grow your business, well, you need to start with step one. So if you go to a lender and you have below average, well, you're going to pay high interest rates. It's not that you can't get them, it's just that you're just going to pay more money. That is, as a business owner, that's not going to look nobody likes the idea of you're just making money because you got so many loans, and then look at all those interest rates that you're charging up. And think about it from, you're the CFO of your own company. How are you misusing your money? Bring that back to your budgeting, right? So if you need to borrow money, how much are you willing to pay for that money? How quickly can you turn around your debt? How quickly can you pay that off? That is a huge thing that lenders look at. How quickly do you collect from your customers? There's just so many things that go into it. Starting to separate your personal and creating a business one is huge as well. Usually when you open up a bank account, the banker will tell you right away, hey, do you want to open up a bank account? Say yes. Or a credit card or a line of credit. If you are in a position to do that, please do that, because it's going to be harder for you to do it later. If your credit is stellar, you're going to get qualified for a good amount to help you fulfill the responsibilities, your financial responsibilities that you have for your business. As far as how do you start? Well, first of all, think of the company that you want. What do you see yourself doing? Are you paying for everything up front? Are you getting partners? Are you going to be getting small business loans? How are you funding this at the end of the day? Just how are you going to pay for all this? Being a business owner is nice up until you got to pay for all this stuff. So you got to look for ways to borrow money if you are in that position. And then how do you borrow it at the cheapest rate possible? How do you borrow it with, almost 0% interest? So that is the beauty of having good credit, that you could borrow other people's money if you are able to pay it back, if you're responsible to go ahead and, do that. As far as if you have inventory, you could write, contracts within your vendors to say, hey, if I pay it within 10 days, can you give me a discount? If I pay it within 15 days, within 30 days, what is that? What does that look like? They're going to want to see that the company, you're going to have to build up some credit history with the company, but those are options that you have as well. And work on your business plan. Working on your business plan is gonna, lead the way to whatever you want to achieve. It's just a way, that's all it is. It's just, you're just saying, this is how I'm gonna do it. That's really all it is. This is how I'm gonna do my marketing. This is how I'm gonna do my financials. This is how I'm gonna do this. You get the point, right? And then lastly, tax planning and budgeting. Tax planning, I've already said it enough, so I don't think I need to put too much thought into it now. But one of the big things that we see, or one of the big things that people think, is that there are no corporate taxes. Yes, there are. As I said, there are taxes. And you have to make sure that you appropriate the right amount of tax, because when you, at the end of the year, if you haven't been paying your taxes quarterly, well, they're going to come at the end of the year. Nobody likes the bad news of like, you owe this much money. A lot of new businesses think that they have enough deductions. But you gotta always be very conscious about what your business plan says, because you could have a lot of losses and they're all legitimate, but there could be a certain tax incentive that you get of doing it, finding your taxes a certain way so that you're not taking all the losses at once. You could carry them over a certain amount of years. So what happens is people don't put money on the side for taxes, and then tax season comes and it's not a good delivery either for the tax person. The tax person automatically, I don't know everybody, but they would assume like, oh, they must know. That's just a misconception and it's just a stereotype that I'm using, so at the end of the day, it is the person's. And even if even your personal taxes, it is your responsibility to make sure that your employer or whoever you're doing business with, that you are paying whatever tax you should be paying. If you want to pay it later, if you want to pay it now, just don't assume that your tax is going to be zero all the time and that you're not going to be responsible for anything. So always try to look at, okay, if my ordinary tax bracket is this about how much I should be allotting for my taxes. I think that's going to help you tremendously. And then structure a way to pay those taxes so that you don't have to pay any fees at the end of the year, because they do charge penalties for each quarter that you don't do it. So that's very important, especially for your C Corps and your S Corps. Those are the big ones. And then as far as budgeting, well, we talked about budgeting. This is a big one for businesses. Like we said, everybody wants to be out there, serving and, bringing, their product, service to the public. So it's very important that people understand, budgeting for everything that's coming in. You also got a lot and account for everything that's coming out. So budgeting is a big thing. Just how you budget for your home, you would do the same thing for your business. Again, part of your business plan, part of your forecasting. So that brings us to our closing for our topic of the week. I hope that this information was finally wrapped up everything for you. I think, these topics for me are exciting. I don't know about you guys, but for me, I could do this all day long. So if you guys have any questions, please don't forget to contact us. We are here to help you with any of your financial concerns that you have. And as always, please don't forget to share this with your friends and family. You just never know who's wondering the same thing that you're wondering. So yeah, that is our spiel for today. Thank you so much for muscling, and you have a great rest of your week.